All right, let's talk about what's going on in Hollywood, because a potential mega merger is brewing that could literally reshape the entire media world. We're talking about Skydance Media making a play for Warner Bros. Discovery. But you know what? This isn't just a story about spreadsheets and stock prices. It's about something way more powerful. And that quote right there, that really gets to the absolute heart of it. We're going to break down all the logic, the numbers, the regulations, but you have to remember it all comes back to that one very, very human element. This is a story about a massive collision between ambition and finance. So first, let's zoom out a bit. We need to understand why a deal like this almost feels like it was destined to happen. I mean, the market has been telling us this story for years. Just look at this chart. This is Exhibit A for why this merger makes so much sense to so many people. For years, these two companies have moved in almost perfect lockstep. When one goes up, the other goes up. When one falls, the other falls right with it. The market has basically already decided that their fates are completely tangled together. And you might be asking, why is that? Well, it's because they're fighting the exact same war on the exact same fronts. They're like brothers from another mother, you know? Both are getting absolutely hammered by people cutting the cord on cable. Both are bleeding cash in the brutal streaming wars, and both are carrying just massive amounts of debt. They both hit their peak back in 2021 and have been sliding down ever since. Okay, so with all that as the backdrop, let's zoom in and look at the actual deal. What exactly is on the table here? The main player making the move is Skydance, which is led by David Ellison. And yes, that's the son of Oracle's Larry Ellison, so deep pockets. They want to buy the entire company, and the simple rumor of this bid was enough to make Warner Bros. Discovery's stock shoot up almost 30%. Wild. Now, how they plan to pay for it is absolutely critical. Skydance is proposing a mix, 70% in cash, 30% in stock. And believe me, this isn't just some random split they came up with. It has huge, huge implications for everybody involved. So here's the fascinating outcome of that 70-30 mix. Even after getting a big 30% premium, the current shareholders of Warner Bros. Discovery would still own a massive 47% of the brand new combined company. So they're not just cashing out and walking away, they're actually rolling their investment into a new, bigger future. So why is Warner Bros. Even a target in the first place? Well, because Wall Street sees it as cheap. It's trading at around 7 times its forward earnings. For a company with such iconic brands, that's a really low number. It's basically sitting on the discount rack, just waiting for a buyer with enough cash. Okay, so if it's cheap, what's the financial playbook here? What's the genius move for a buyer like Skydance? Well, it really all comes down to 2 key ideas: scale and re-rating. The really big idea here is something called scale re-rating. Now, this isn't about overpaying today. It's actually a bet on the future. The bet is that once you smash these 2 giants together, the market will look at the new, bigger company and see it as safer, more stable, and because of that, will value it more highly. You're buying it low now, hoping the whole market re-rates you to a higher value later on. And that re-rating isn't just based on wishful thinking, right? It's based on real, tangible benefits. A bigger company gets better credit ratings, which means it can borrow money more cheaply. Simple. It has more muscle to flex when it's negotiating with cable distributors. And of course, the big one, you can cut a ton of overlapping costs. But this is where that whole financing mix gets really tricky. So just focus on the lines going up in both charts. The one on the left shows that the more cash you pump into the deal, the higher the company's valuation gets. That's great. But the chart on the right shows the problem. More cash also means you're piling on a lot more debt. It's this incredibly delicate balancing act between boosting the value and taking on way too much risk. So the financial logic, it's there. It makes sense. But with any deal this massive, you have to ask the billion-dollar question. Will the government even let it happen? The really important thing to understand here is that this is not Google buying some small startup. This is a merger happening inside what regulators see as a declining industry. We're talking legacy media. And historically, they don't block these kinds of deals. It's often seen as a move for survival, not a move to create some new, scary monopoly. There is one potential little wrinkle, though. You have to wonder, could a regulator like the FTC's Lina Khan try to frame this as an AI adjacency deal? I mean, Skydance is tied to Oracle, which is a monster player in AI. The argument could be made that they're trying to corner Hollywood's content libraries to train AI models. It feels like a long shot, but hey, it's out there. That said, let's talk political reality. The odds of this deal getting approved are still considered very high, especially with a Republican administration. You have to think the timing of this bid is no coincidence. Bidders know that the window for an easier approval might be right now. Which brings us all the way back to where we started. The math works, the regulators will probably give it a thumbs up, so what in the world could possibly kill this deal? Ego. It really might just be that simple. On one side, you've got David Zaslav, the CEO of Warner Bros. Discovery. He loves the celebrity, the limelight, the prestige of being a Hollywood power player. And on the other side, you have David Ellison, who desperately wants to stop being known as just the son of a billionaire and build his own empire to become a true mogul. Their motivations are fundamentally different and potentially really combustible. And here is why this matters more than anything else. For the executives at the very top, a deal isn't just about the share price. It is about their job, their control, their legacy. If David Zaslav even gets a whiff that he's being pushed out of the driver's seat, a generous offer for his shareholders becomes completely irrelevant. He will find a way to kill this deal. So, yeah, rivals could jump in with higher bids, and the financial models can always be tweaked. But the ultimate fate of this massive deal, it might not be decided on a spreadsheet at all. It will probably be decided by the ambitions and the egos clashing in the boardroom. Because in the world of $100 billion deals, the size of the check definitely matters. But as history shows us time and time again, ego often matters more.